Good morning and happy Monday. I'm Mehdi Sunderji and welcome back to OETV. I hope everyone managed to watch some of the football, the World Cup. Soccer, football. We'll clarify here. Sorry to Team USA and of course Ducks' Socceroos, but come on England, let's see if we can bring it back home. I'm standing for Scott Duxbury, but as always, we welcome back Brendan McCarty from Column E. Brendan, how
Welcome
are you,
back.
sir?
Okay. How are you
And
doing?
I'm good. Hope you had a good weekend.
It was good. It was good.
And we also have Gary Brode, and he's not in his regular setting in Connecticut, but instead he's in Thailand. Welcome to the show, Gary.
Thanks, Mehdi. Great speaking with you. It's fantastic here in Thailand. Beautiful culture, beautiful people. I just have one complaint.
What's that?
Mehdi, I've been here for a week, and King Rama has not invited me to dinner. Now, by all counts, he is an excellent and wise king, well loved by his people. So in the interest of good international relations, I would like to fix that here on Open Exchange TV. King Rama X, if you are watching Open Exchange TV, I would like to invite you to dinner. I will be here in Thailand for another few weeks. Would be great to see you.
Gary, we'll send the link right after the show just to make sure that he does tune in. So, wait for that invite. It'll be coming soon.
Good. Thank you.
So lots has been going on. Let's start with last week. The US, Powell signaled smaller rate hikes, which sent the market on a bit of a tear. The Washington Post, Catherine Rampell, reported that Powell admitted he was wrong on interest rates and that more officials should be doing that. I've kind of looked at a lot of the media coverage on Powell this week, and I'm not seeing any admissions of wrongdoing anywhere, but I guess that comes down to, personal interpretation. So all the dust is cleared now. Surely this means that everything's all right in the US and it's the end of a bear market, right? So actually, I'm obviously being a little tongue-in-cheek here, but where do you stand in regards to the market, Gary? Bullish or bearish?
So overall, we're bearish. I don't know what's going to happen over the next few weeks, but basically we have Deep Knowledge Investing identified inflation as a gigantic problem back in November of 21, when everybody was using the word transitory. We said that's completely ridiculous. Inflation is a huge problem. It's understated. And as soon as the Fed started raising rates, we told all of our subscribers to short the market in the first week of January of this year. That's been hugely profitable. Where we are right now is, as you pointed out, Mehdi, everybody's very excited because the Fed is reducing the rate of rate hikes. So they're going to hike more slowly. I don't think that's so much different from what anyone expected. I don't know that anybody thought we were going to be getting 75 basis point rate hikes for the rest of eternity. But basically what's going to happen is when companies announce fourth quarter earnings, late January, early February, you're going to see we're heading for some bad economic times. The Fed rate hikes are going to work in slowing the economy, and they're going to bring down their guidance, their estimates. And so we think that's going to be the thing that's going to take the market down.
Okay, so you're moving into camp focus on earnings estimates away from Fed issues.
Yeah, I think it's important to be thinking a few months ahead. And, one of the things that I find particularly amusing about the sell side is just how far behind they typically are. The sell side right now is waiting until companies miss and lower guidance, and then they'll lower estimates. We think that's completely ridiculous. There's no reason to subscribe to sell side research for that. The Wall Street Journal can tell you what happened yesterday. We're telling you what we think is going to happen over the next couple of quarters, and it's important to be predictive. We have newspapers to tell you what happened before.
Very good point on newspapers, but no one reads those anymore. Also, and Gary, just on that point, just in regards to a delay, we've also seen the fact that a lot of large corporates are making capex cuts, right? So while these things all seem well and good in managing their businesses and their revenue streams, it takes time to feed through on the underlying issues where they're going to have to cut some of their earnings numbers. So, I guess there's that delay that comes from that as well.
Yeah, that's exactly right. They're cutting their capex. They're cutting some of their people. Now, the last employment report, and I know we'll get to that in a bit, was strong. But companies aren't cutting people because they think things are going to be fine. And one of the things that we've been seeing from the sell side is they're lowering their revenue estimates, but keeping the margins the same. So I don't know, maybe one of you guys can tell me, does nobody have fixed expenses anywhere? because this is literally impossible. If you've ever modeled out a company, if you lower your revenue numbers, you're going to lower your margins by more. You're going to have to lower your earnings numbers by even more. So even the people who have started to lower their estimates for next year haven't done so enough. We've been watching numbers slide through all of 2022, which is what we predicted about 6 or 7 months ago. And we think that's going to continue into 2023.
Gary, didn't you get the email? It's the land of the floating expense. You're fully variable now in life. Another hot topic, China. So China is still continuing to deal with their COVID outbreaks, and we all saw the protests last week, which was awful to see. But when you see these types of images, you generally see markets under a lot of pressure. But China was up for the week, and many Chinese ADRs and ETFs had some pretty decent moves. Look at KWEB, for example. Are these moves the start of a bigger rally, or is it a dead cat bounce, Brendan?
We've been tossing around a theory. So here in the United States, when the Fed injected a ton of cash into the system, it basically lifted all assets and they gave us an inflation problem. PBOC has been working overdrive to inject money because their real estate market, well, we've all read about it, so I'm not going to rehash it, but it's in trouble. So, but you're starting to see these indexes like the Hang Seng we were looking at the Hang Seng at one juncture. Of all of our international charts for the past 50 years, there was nothing as oversold as the Hang Seng was. That includes the U.S. markets in 08 and 09. So it's powerful reversal lately, and it's continued. Is more of a sentiment based than anything. The Shanghai comp has lagged the move. So we wondered if, all right, so if you inject money into the Chinese markets, you're going to lift both boats. So why is China lagging the Hang Seng? So one of the premises we've been working off of for the markets is 2000. We're in 2002, going into 2003. One of the biggest things of 2002 and 2003 was a peak in the dollar. We've had that, and a massive global rally, which we've seen in the European markets for the last 2 months, and they've been ahead of the U.S. markets ever since the dollar reverse. I think the reason why the Hang Seng is bouncing more violently is because of that global rally and the way things are moving. So it's more of I think it's a tide shift. I think Jay Pulaski may have been on with us several months ago, and Jay and I were saying, was it Jay? I can't remember, but we said that there was going to be a shift in assets into the global markets. We didn't know when. Well, it's happening, and I think that's what's playing out right now. That's why you see the China markets rallying in addition to the PBOC. The problem is the news element with these two markets. Like Dux and I did love it, like it, leave it with Chinese stocks a couple weeks ago. And the first week they were wonderful, and the next week they were terrible. And that has been the nature of, Weibo was up like 12% one week and down 14% the next. It's just wild moves. And Baba did the same thing. It went up against us and then fell. So basically with China, the problem is it's the news. Like one day things are good. Things are reopening. Like this morning, the mobility indexes look like they peaked. So people start moving around a bit more. But next week they may not. They'll just we're under the opinion that the Chinese government is losing control of its people. They're trying to push back because that's why they crucified tech. That's why tech had the power, if you will, and they basically tried to ruin that power by running them out. So if this continues and the positive news continues in China, I wouldn't surprise if there's some negative news to offset it. So long story short, the unrest is not going to stop. I think that's a continuing trend. At the same time, there's global flows of money going everywhere. It's got to find a place to go. It's leaving the U.S. And that's probably why these markets are rising. Japan's the one outlier. It's not going anywhere. So they're running into China thinking, all right, the bottom is in. People are moving around a little bit more. There are a lot of green shoots over the last several weeks, like small little things. There's still the bigger picture, but we're basically, I'm rambling on here, but long story short, it's a hard market to invest in. Right now, the trend is higher. Next week, the news might reverse it back lower.
Okay. So you dip your toe a little bit, maybe get involved here and there, but lock in some profits as and when things are bouncing and dipping.
Yeah, China's kind of running, the Shanghai comp is running to resistance. The Hang Seng has climbed over it. The Hang Seng, if the global flows continue, the Hang Seng will probably benefit from that. I mean, the thing absolutely got trashed. Like to see an index just get absolutely smashed like that was crazy. So I think that's where the money's flowing. I don't know for how long, but this is one of those markets where fear of missing out, right? We're seeing a lot of that right now. We're seeing it everywhere. Like the DAX and the CAC 40, Europe's has a war on its border, yet the DAX and the CAC are killing the S&P. I mean, on this move higher. Does that make sense? I don't know. Does the Hang Seng climbing after not doing any business for several months? Does that make sense? I don't know.
Well, we're going to get to Europe in a moment, but before then, let's touch on Japan. So, Gary, we've covered Japan before. I think you and Dux spoke with Mark Rossano, and you talked about sovereign debt default. If you had to choose between China and Japan to invest in for the next 12 months, where would you lean towards?
Mehdi, it's a tough question. I think Brendan made some great points on China, and clearly he's been very nimble in moving in and out of that market. In general, I don't see China as investable, and I understand that's been a point of contention in the markets for the last couple of years. The issue is that the government hasn't completely lost control of the people, and you have a situation where, as Brendan said, one person can just decide, hey, we're going to put this entire industry out of business. I don't like to be I don't like to be in binary situations. I don't like to be in a situation where one person or one agency or one decision by a judge or a politician or a dictator can just completely ruin your investment thesis. It's not where I want to be. In Japan, I would be thinking about whether the company that you're looking at is an importer or an exporter, right? So the big issue in Japan is they've been defending their 25 basis point rate level, which is crushing the currency. If you think about it, right, you can get 3-4% here in the United States. And if you're getting 25 basis points in Japan, you have people selling the yen and buying dollars so they can buy US treasuries. And that's pretty much what we've seen. And so as long as the Bank of Japan is going to defend that interest rate, and they need to defend that interest rate because their debt to GDP is about 260%, so they can't afford a higher interest rate, you're going to have a weak yen. So now let's imagine that you're Sony and you're selling PlayStations for $500. Well, that all of a sudden is a lot of yen. It's pretty good for your stock. And regarding the currency, you could hedge that, right? So you could buy Sony, sell PlayStations in dollars, get a lot of yen, and we could hedge the yen and sort of sterilize that bet and hedge it. Where Japan is going to face a lot of difficulties is it's an island nation without a lot of natural resources. And so their imports are really going to suffer with the yen at 100, I think 134, 135 to the dollar. And maybe someone can help me out. I think it was just over 100 to start the year. A 30% move in foreign exchange in 1 year is unbelievable. Normally, you'd be looking at 2-3% moves as sort of standard. And so if you're in Japan and you're importing, you really have a problem. And that ultimately, between that and the Japanese budget, is what's going to have to break the whole situation. It's not sustainable.
Not sustainable. That's the very important point there. And Gary, thank you for the word nimble. That's what I was struggling with trying to talk to Brendan a moment ago as well. So I appreciate the vocab lesson. Brendan, you did touch on Europe briefly as well. Let's move over there. The Euro Stoxx is up more than 22% this quarter and down 7.5% year to date. Should investors be looking at Europe as an investment, especially considering the expectations for a further pullback in the US dollar strength?
So they've been looking at Europe already. The DAX. So we had that massive sell-off in September across assets. The DAX and the CAC 40 were first to jump, and that probably tied to the euro getting a little stronger and the dollar weakening. And you saw those flows, like the DAX is screamed, like just a massive move. CAC 40, it's not like the French economy is like the next coming of the greatest growth economies in the world. But yet the CAC 40 is looking really strong as well. And it kind of blows my mind that these two markets, it's the same. Their bounce looks like the Hang Seng. The Hang Seng came a month later, but they're both violent moves to the upside, which argues that, like, if you go across Twitter these days, the Bears, and not to take a side here, but the Bears have been pounding their chests. I mean, there's certain guys who just like to advertise it now. And it's getting kind of annoying, to be honest. But you see it on Twitter, they're like, oh, markets suck. Probably the wrong word to use, but the markets aren't the best. And these guys will probably short them. You know what I mean? Like, if you were short, like the Hang Seng, that thing kept falling and falling and falling. How many people jumped into it to short it, right? So that momentum just kept falling. So it's like free money every week, every day. And then all of a sudden it isn't. Well, I think the European markets are much the same. You were playing on war, you're playing on Ukraine, and you're like, oh, in the natural gas crisis that was supposed to come and still hasn't. Surprisingly, it's been abnormally warm, right? But anyway, I would just say that the run has been extreme. That like 22% run for any index. It's like Gary said with the yen going 30%. During bear markets, we see violent moves like this. I'm not about to say, all right, we have set another bear market move, but the breadth hasn't been following through. So one way to support a rally is to have breadth catch up with it. Breadth hasn't really caught up with it. And that argues that perhaps the move might be extended. At the same time, you don't find me jumping in front of it saying short, because the trend is, you got to play the trend. It's the same thing. Our market model, our market model, we've been like, we trade bearish, we trade short, more aggressively short of the markets. Well, you have to respect the rising trend of the S&P. It's just been climbing and climbing and climbing. And you can fight it, and then you can lose lots and lots of money doing so. So the same with the DAX and the CAC, they just continue to power higher. I don't know if they're sniffing out an end of the war, a warmer winter, better earnings. I mean, the European market's a heck of a lot cheaper than the U.S. markets, if I'm not mistaken. I think Europe is trading at like a 12 or 13 PE. I'm not entirely sure of that. I'm guessing it's been ages. But anyway, long story short, Europe's been powerful. I could see it continuing higher as people chase it. And I think that's it. I mean, you can get in front of it. And if this is 02, 03, they'll correct like every market will into 03 or 2023 in this case. So I would just, short term looks powerful into year end. I wouldn't be surprised if it peaks and backs off while breadth catches up and then it continues to rise. I mean, we had a 9-year rally in European markets following 02, 03. Even like it very well could be in the cards. I mean, nothing repeats, but often rhymes.
Well, we'll keep an eye on Europe. We might be riding that one at least for a few more months anyway. So we'll definitely stay on it. Doug's favorite part of the show: like it, love it, leave it. Everyone knows the rules of the game. 30-second quick fire answers. And this week we have names that Gary Brode has chosen. So they're definitely going to be over a wide range of industries. Let's jump right in, shall we? Innova International. Gary, to you, kick off.
Love it. What we've just seen in the United States is we got a great employment report. People are employed. The average increase in salaries is 5%. So people have money, but their spending is even greater than the additional income they're taking in. What we're seeing is savings are coming down, debt is going up, but people are able to pay their bills. Innova lends to those people. So the last few quarters, they've had record loan initiations. We expect that'll continue. Love the company.
Fantastic. Brendan, what are your thoughts?
First, I love this list. So I haven't seen half these companies before. So this is cool. We often talk on like companies we know, and then I have to give a pick on something I've been blowing up all year. So it makes it, this is a little better. At least I haven't blown up any of these ones yet. No, I'm just kidding. Innova. So I honestly never heard of it, but I like the chart. It's holding 38 well since breaking over it a month ago. Looks like 44 is the top of the current range.
Fantastic. Next, we have Las Vegas Sands, one of my personal favorites. Gary.
I love it right now. The information we got a week ago, which was what was expected, was that the company succeeded in its retendering process. The next thing that we need is for China to open up. And what Brendan was talking about before is the people are putting pressure on the government to do that. And as much as the government is saying, no, we're not going to bend, what we're actually seeing is they're starting to relax a little bit on some of the COVID regulations. Macau is starting to reopen. There is an enormous amount of earnings potential that's just been sitting idle for 3 years.
Brendan?
I like it. I had a big move last week. Nice breakout through 45. Current area of resistance from the previous rise, but the chart's up. So top of the range is 53. So I like it. And also in regards to China, money talks. Need money to pay those huge bills that they're having. So they'll definitely open Macau. They need the gamblers back.
That is a great point, Brendan. You know, something like 3% of China's in tax revenue comes from Macau alone.
No
and
way.
It's all gaming.
Yeah, that's interesting.
Yeah, you had it nailed. You've got the thesis right.
That's a crazy stat.
I mean, the house always wins, so that's free money, really. Anyway, sorry.
Always wins. All right. Well, Coursera next. Gary?
Love it. I think what we've seen over the last few years is that online education works. People want to travel, just like so many people want to be digital nomads in their professional lives. I think students feel the same. We're at a situation now where somewhere between 1 in 4 and 1 in 5 US college grads have so much debt, they will never pay it off. They will be debt slaves for the rest of their lives. Coursera gives people the opportunity to study and learn from anywhere in the world at a hugely discounted rate. And they're working with now over 1,000 different companies to help those companies upskill their workers. And so in a situation where the labor market is as tight as it is, do you want to fire someone and try to hire someone who's better qualified, or just better train your people? Coursera helps with that, and the revenue growth there is enormous.
Gary, we're halfway through this segment and you've had 3 loves. I hope you haven't just picked everything that you love. We've got to have a little bit of a mix up here, haven't we?
I promise, Mehdi, I've got things that I hate coming up.
Okay. Well, we need some of those as well.
All right.
What about your thoughts on Coursera?
So it's interesting. I didn't know what these guys did. I think I have a friend who actually does stuff for them. I don't know. Anyway, I like it. Tough one since it has a short history, but it looks like it's heading towards resistance above. More range bound at the moment, but I like it. I think the climb is there. It's a tough one, but I like it.
Okay. Next up, we have 2U.
All right, Mehdi, that one I hate. That's my leave it. 2U is in the same business as Coursera, online education, but it's a very different business model where Coursera helps people learn from anywhere at discounted rates and they get great credentials. 2U, their business model relies on getting people to pay on-campus prices while they're learning online. So try to imagine you are doing a master's degree, you never set foot on campus, you never meet a professor in person, and they're still trying to charge you $120,000. On top of that, there's a whole customer service issue where people get admitted to these schools and they need help. And 2U says, no, you're a student of this university. And the student calls the university and they say, we don't know you. You came in through 2U, you're not ours. And so these people are paying 6 figures for degrees and they can't get anybody to help them. It is a terrible company with a terrible business model. Clear enough, Mehdi?
I think that's extremely clear. And we might have a pair trade there, long Coursera, short 2U, so you can be dollar neutral and off you go. Brendan, what do you think, sir?
I would leave it. These under 10s are tough, but like Palantir was a tough one, was under 10, tough to pick. I know different industry, but whatever. I would leave it. Crossed over 8 above and below it last week, and then went back below it. Support maybe a 750, but it doesn't sound like a great story based on what Gary just said. So I would leave it.
Okay, 2 leave it. HCA Healthcare, Gary.
So fantastic company. We are leaving it for now. Deep Knowledge Investing was involved. We made a lot of money in the name. It is absolutely the best management in the business. It's a phenomenal company. We also think they're going to get the revenue increases they need from the insurance companies going into 2023. Our concern is through our partners at Stream Research, we've spoken to a number of hospital presidents, hospital administrators, people in the hospitals who are trying to run departments and budgets, and it is just expensive right now. They're getting away from some of the really expensive travel nurses, but even orderlies, people who handle the technology side of things, radiologists, even the people who clean in a hospital, all of the devices that they use, their supplies, everything's just gone up in price. It's going to be hard for them to hold margins. It's going to be a great company to buy at some point, but we're going to wait to see better cost control. I don't think it's management's fault, but they're going to need to get through this period first.
Interesting story. Brendan.
That was a lot of cool information.
Yeah.
I honestly just let's get. That's a fantastic. I'm debating my story here now. No, like healthcare has been an amazing play this fall. It just continues to be. The one thing that in this chart I like it still. Last week's candle isn't the best, so that could indicate some indecision. But like I think every pick we've had on this lately with these healthcare companies, they just continue to climb. It doesn't matter what's happening in the markets. Healthcare just continues to climb. But Gary makes a heck of a lot of great points there. We were talking about a cost squeeze on the retailers next year. Like I mean, it's got to be everywhere. Like you have demand one moment, but as soon as you lose that demand against your rising costs, you're in trouble. And that's sort of what sounds like is happening there. But I like the stock in the short term. I think it continues to climb. I think it's one of those plays that the money managers see. You want the best performers in your portfolio, right? And HCA is going to be one of them. What's interesting about HCA, and from a grander perspective, is it rose during the pandemic. It didn't pause, strangely enough, until late 21 when everything paused. There's a huge gap in performance there. If HCA has a hiccup, I wonder if it fills it like Morgan Stanley did, like several tech companies did. They all filled their pandemic gaps. I wonder if that's something for next year. I don't know. Gary just got me thinking about it. I'm not a great long-term thinker in stocks like this, but I like it in the short term. But, longer term, I wonder if all those factors he brings up goes to filling that gap that was the pandemic till 21.
Either way, it definitely seems like one we should have on the radar for short and long term. And last but not least, TPL, Texas Pacific Land Corp. It goes ex-dividend on Wednesday with a $3 dividend as well. So, Gary, what are your thoughts?
We like it. It's a fantastic company. It's a great play on energy. Deep knowledge investing, we are hugely bullish on energy right now. We think it's a great multi-year play. TPL has a phenomenal cost structure. They're basically leasing out land rights, water rights. The reason that we like it as opposed to love it right now is the stock's run up an enormous amount, and some part of that is expectation of activist activity. We think that there are some very large shareholders who are smart and have the company's best interests at heart, but we think they're going to be less aggressive than the market is expecting. We're watching it right now. We think it's a great long-term play. I'm hoping to buy more of it back at lower prices.
Got it. And final word, Brendan?
So I like it. I didn't realize what they actually did. I probably shouldn't admit this sometimes, but honestly, no, water rights is huge. Like if you want to play water, I'm not saying like it because of water, but water is a huge thing for the future. We had a drought here in this country this past year, and it created an inflation problem. Imagine if you can play water. This might be an option for it. The energy side for me, I'm not as bullish on because crude. It should be more bullish because the dollar is coming down, but crude is not behaving like I thought it would. So the chart moves lower. But the stock itself, I like this. You don't see too many parabolic moves these days in any stocks. So this is like one of the few. It like skipped like from 1,800 all the way up to 2,700 and then backed off. But it found support at 2,500 recently, which makes it a nice bounce. That's why we like it. I think you can get to 27 at the top of the range, and you get a dividend in the meantime.
There we go. Thank you so much. Some great names in there, Gary, and I learned a lot. I wasn't as forthcoming with Brendan's honesty about not knowing some of the names. I didn't know any of them, to be honest, but I with it. No, it was fantastic. Thank you so much, guys. I really want to thank our wonderful guests, Brendan McCarty and Gary Brode. And next week, Dux will be back. Thank you for watching, and good luck investing.